Over the course of 2007 and 8, the magnitude of the upcoming Great Recession became clear to the U.S. Federal Reserve. An uptick in defaults in the subprime mortgage market had quickly escalated into a financial industry on the verge of collapse. In response, the Fed cut its conventional policy tool, the federal funds rate, virtually to zero, a cut of more than 5 percentage points. This was the first time short-term nominal interest rates had reached zero since the early 1930s. How was this dramatic cut supposed to help the U.S. economy? How was it supposed to save jobs and boost GDP? And more importantly, did the cut work? In this episode, we'll find out. Fed policy typically impacts the economy by influencing long-term interest rates. These long-term interest rates tend to move in the same direction as the Fed funds rate. So when the Fed dramatically cut the Fed funds rate in 2007 and 8, long-term interest rates should fall in response. Now this is important because these long-term interest rates influence the amount of money spent by businesses and consumers. When long-term interest rates fall, it becomes less costly to borrow money, which then encourages businesses and consumers to spend more. Businesses buy machines and build factories. People go out and buy a home or a car or some other durable good. A fall in long-term interest rates has two other critical impacts. First, it tends to push up the value of stocks and bonds, as future profits are worth more in today's dollars. This raises people's wealth and so further increases consumer spending. Second, it tends to cause a currency depreciation. That is, in response to lower long-term interest rates in the US, the dollar falls in value relative to other currencies. A cheaper dollar then makes American-made products cheaper abroad and foreign-made products more expensive at home. This in turn encourages people to buy more from US businesses. All of this additional spending from businesses and consumers, both domestic and foreign, raises employment and GDP and helps the economy recover. This is what the Fed thought would happen in 2007 and 2008 when it reduced the Fed funds rate virtually to zero. And now the key question, is that actually what happened? Did the Fed's action help the economy recover from the Great Recession? To answer this, let's start by discussing whether the cut to the Fed funds rate lowered the long-term interest rates. As it turns out, this is harder to determine than you might think because there are many factors, including the Fed's action, that could impact long-term interest rates, especially during the chaotic period of 2007 and 8. But by zooming in on the period immediately following the announcement of the policy change, we can isolate the impact of the Fed's action on long-term interest rates. 3 economists followed this event study design. They found that the cuts in the Fed funds rate did indeed reduce long-term interest rates, saying, quote, "The conventional monetary stimulus chosen by the Federal Reserve significantly lowered real borrowing costs faced by businesses and households. This finding is consistent with a large number of other studies with different designs." The size of the fall in long-term interest rates was substantial as well. Other research has suggested that long-term rates fell by over a percentage point due to the Fed's reduction in the federal funds rate. So, to answer our first question, yes, the Fed's action did substantially lower long-term interest rates. Now, the only question that remains is whether that reduction helped the economy recover. As I said earlier, lower long-term interest rates make it cheaper for companies and households to borrow money and should lead them to invest more and spend more. We certainly see this desire in anecdotal evidence. But more importantly, past research has shown that lower interest rates do indeed boost spending. Specifically, lower rates lead to greater corporate investment and greater consumer spending on everything from everyday items to housing. Other research has shown that the lower rates stimulate the economy as a whole, leading to lower unemployment and greater GDP. So yes, the cut in the federal funds rate not only lowered long-term interest rates, but it also would have provided substantial support for the economy. Before I end this episode, there's one more point I'd like to make. While the Fed's rate cuts likely stimulated investment and consumption relative to what they would have been, that doesn't mean that investment and consumption were rising. In fact, on both accounts, companies and households were pulling back. We can clearly see this in the data. Here, I've plotted private investment and consumer spending on durable goods over time. As you can see, investment and consumer spending fell in 2008 as companies and households worried about the future. These movements occurred despite the tremendous and productive efforts of the Federal Reserve, and would have been more severe if it had not been for the Fed's actions. In short, the evidence suggests the Federal Reserve's action of cutting the Fed funds rate to zero likely helped the economy recover from the Great Recession. But that help was not enough to fully stabilize the economy. This is why in late 2008, the Federal Reserve turned to use its more unconventional and more vigorously debated policies of forward guidance and quantitative easing. In the next episode of Econphiles, I'll explore the impact that these two unconventional policies had on the U.S. economy. Thanks for watching.